Well, hello, and welcome back. Today, as promised, I'm going to talk about a cool strategy that I was talking in the previous video. And actually, I will be discussing two strategies. So, for different types of people, you can choose one of them. So, stay tuned. And if you want to learn more, stay with me. And obviously, push the like, subscribe to our YouTube channel, and read our books. But anyway, before I dive in, let me tell you a quick disclaimer that I'm not a financial advisor, so whatever I'm saying, take it with a grain of salt. Do your own due diligence. This is just the way I trade. I'm not saying that you have to trade it that way. Now, here's the idea. The idea for this video was, can we have a strategy which makes money during the bull market cycle? And specifically bull market, so when it's not a bull market, it's not going to make much money, but when it's a bull market, it's going to make a lot of money, okay? And then if it's a bear market, unfortunately, there's no like one fits all solution, obviously, so it will lose money, but it will lose money, limited money. So that's what I'm going to discuss, okay? Here's the what type of system fits that part of that kind of objective. So this kind of system, it's called long-term trend following. I already had it on my the channel. I think I did, but if I didn't, that's the first one then. But basically, that's one of the types of systems that I use in my personal trading as well a lot, and I actually love it because again, they adhere to that main objective. They make money when the market makes money, and make money more than the market does. Okay, so that's the main reason for outperformance of it. But then the concentration that there's why I have two systems, and system number two will be where I'm concentrating in specific stocks and will outperform the market that way. So let me actually dive into a little bit more so you know what I'm talking about. In this case, I decided to choose the simplest system ever. Some people say that, oh, the channel trading is dead. I can guarantee you that channel trading is not dead. It's still quite alive and kicking. I will show it to you. I can prove it to you. So what it is when we get in during the breakout above the channel, and then we get out when we close below the channel. That's called channel trading. The channel is basically, there's a signal, which is your exponential moving average. This is the Keltner. And the ATR defines the channel. So basically, the price goes above the exponential moving average and below exponential moving average. So that's my upper bound of the channel, and that's my lower bound of the channel. We get in when we closing above the upper bound of the channel. We'll get in and we'll stay with it, and we trail behind. Why? Because as it rises, the channel rises with me. And then if we close below the portion of that channel, we will get out. That's all we do, okay? And does it work? As I said, it does work. Let me show you. So first system I want to do, just so that you know the benchmark. And first of all, it's for more lazy people because it doesn't trade a lot. But it allows you to verify things, and you will see that it works. So I'm choosing the QQQ. QQQ is the NASDAQ 100 ETF. And I can test all the way back to 2000 something, basically whenever they introduced the QQQ. But the idea is that I will test it from 2007, just easier for me to test right now. In next videos I can test further if people will be asking. But anyway, so here I will use the same Keltner, as I said, the same approach where we are trading above the 200-day Keltner, and that's my EMA, and the 2 ATR channel, and ATR is the 14-day ATR. Then I just enter. As soon as we are above that channel, we're entering into the QQQ as market unopened at full position. We just get all in. And then once the QQQ closes below that channel, the Keltner 200-day moving average and 2 ATRs, then we'll just get out as market unclosed the next day. Okay, that's it. These are the rules. It's the simplest system ever. Here's the result. As you can see, we can generate about 12% on average, the compounded percent, 12.29% CAGR. And my maximum drawdown is around 26%. So it's not that huge compared to what the market does, by the way, especially NASDAQ does. My win rate is 71%, happen to be. My win-loss ratio is 4.38, meaning that for every dollar that I risk, I actually win 4.3 $5.8, and it only had 27 trades in the last 18 years, 18 and a half years. So it doesn't trade often, but you can see it still trades. Like this is the 2025. It got stopped out back in April or in March, whatever it is, over here, and then it got back in, I think in May, and now it's going up because, well, the market is going up, right? That's why I'm saying here, in this particular case, this channel trading, it's very simple and it has all the features of the long-term trend following approach. Why? Because we can stay with the trade for, on average, 264 trading days. Just so you understand, right? We stay for quite a while with the trade. Now, let me show you what the returns are. And this is per year. This is the yearly returns. But the more important part is this number of trades. And trades are counting as getting in as a trade, and getting out is a trade as well. So that is why when you see some odd number like 3, it means that it got in, got out, and got in again, and then stayed for a while, and then got out again over here. So basically, it's both. It's the trade is basically when you trade, when you pay commission. That's what the trade is in this case. Okay, and I mean it makes money, as you can see. It doesn't make a lot of money. Some years it loses, but that's what the market does as well. And here's the monthly. Again, like in March, it lost. Oh yeah, so it stopped out back in March, stayed out from that mess in April because of that same feature that I'm introducing you, the channel trading in this case, and then May it started making money. In June it made money as well. So I mean, as expected, this is what the system does. Okay, what you can see that with this trade channel approach, you can see that I highlighted the areas where it helped us. You can see that this is the drawdowns for the market, the red ones. So market went down like 50-something% in 2008, while our system went down to only 26%, right, and stayed flat. Or around 25%, I think it stayed flat, or 20 even here, or something like that. Then the 2018 again, it stayed flat over there. In COVID times, it stayed flat. It's like it basically didn't go all the way down that the market did. In 2022 again, it stayed flat while the market did all the zigzag. So in April, as I said over here, in March, it stayed flat for a while. So it helps you during the down times. As I said originally, it's not gonna keep you completely out from the losses, but it helps you. But there are also areas where it didn't help, like over here in 2015. You can see that the market did this kind of a zigzag, and it kept on, like this is basically whipsaw, where it got in, got out, stopped out, got back in, and then immediately got stopped out again, got back in, and then it rallied up and continued on its merry way. So overall, it didn't outperform the market, which is again expected from using the rules on top of the QQQ. But it did help us with the drawdowns, right? So from that perspective, it helped us. Now, here's the actual system. The system is NASDAQ 100, so we're using the same exact approach. I mean, I do have liquidity check just to be sure, even though with NASDAQ 100 stocks, it's not as important. So we're working with NASDAQ 100 stocks, current and past stocks, but only when they were part of the NASDAQ 100. It's called index constituents, okay, just to be sure. Same exact rules. Stocks closing price is above the Keltner to get in. We get in as market on open. And then we rank because we wanted to concentrate. We want to get in only in 10 positions at any given moment. We don't want to get in with 100 positions, right? At any given moment, we may have 70, as an example, candidates. But we don't want to get into just every single candidate. We will get in by specific ranking rules. So in this case, I'm using the highest dollar volume of the last 3 months. What does it mean? It means that I'm getting into the most popular stocks of the day. Okay, so like be it Nvidia, Microsoft, or Apple, whatever it is, because I mean we have 100 stocks, you may have 70 different candidates, but in reality we only enter into first 10. Only if we have 10 open positions, by the way, too. And the way I exit, well, I exit when the stocks goes below the 200-day moving average and the 2 ATR, so which is the Keltner for that stock, and we exit it as the next day on close. With one caveat, we want to have the guard rules of our original QQQ system, right? We still have our market filter. Some people call it the market regime. So the regime which checks SPY and NDX closing prices to be above 200 the 2 ATR, above the Keltner, only then we will allow our stock candidates to get in. And then if, let's say, market itself closes below the Keltner, we will close all of our positions. So we're not going to stick around with them, regardless where each stock is. We're just closing them all, okay? That's all we do. So having this approach, all of a sudden, we can generate 17.7 CAGR. Yes, my drawdowns are slightly bigger, 31% maximum. My win-loss ratio is less because now we're operating with individual stocks, no longer with just the whole market. But the main idea behind it is because we're using concentration and the index itself, the ETF, has so many things in there, whole 100 stocks, right? Some of them are laggards, some of them are performers. We are trying to stick to performance only. We're not going to go into every single stock in there. That's the reason for that ranking that we have. So we have a lot more trades. Instead of 27, it's 416 trades right now. But we are outperforming the market. It's still long-term trend following system. So my win-loss ratio is right above 1 a lot. I'm still staying with the trade for 160 days on average. My wins and my losses are pretty much distributed in a similar fashion as before. So from that perspective, it adheres exactly to the objective that we're trying to do. And you can see it as well. When this is the red one, this is the benchmark. This is our QQQ, right? As QQQ goes up, we go up higher and faster. As QQQ goes up, we go higher and faster. Same thing here. QQQ goes up, we go higher and faster. But when QQQ drops down, we go into flat. Or like here, we go in flattens, meaning that we are staying in cash. And we protect ourselves. So here's the statistics for it. As you can see, it makes more money than our original QQQ system did, because this is what the QQQ did by itself without any rules, and this is how we are outperforming or underperforming the QQQ itself, the Nasdaq 100 index. Okay, but you can see like in 2024 it would have outperformed it by 31%, so it outperforms it by a lot more than, let's say, the index itself does. Even right now, right now, let's say we're underperforming because, again, we are not in a full-blown bull market yet. Even though we're trying to make new highs, but doesn't mean that we're making the new. We are in a bull mode yet. It could be shaky, right? With all this Israel, Ukraine, Iran, Russia, all these wars happening, they affect a lot of things, and the tariffs. I mean, they affect a lot of things, but if you don't want to care about what's happening in the world, just looking at the more from the abstract way, this is the way to do it as an example. So here's the comparison, just kind of like a visual comparison, because obviously probably it's too little for you to look at the numbers. And here, this is my original curve. You can see that the benchmark is above the equity curve. Here, our equity curve is above the benchmark because obviously the whole objective was to outperform it. And in similar fashion on the drawdown side, we're still outperforming in a similar way as before. Now, here's the pros and cons for using this approach. If you sticking with just QQQ like I did before, you're probably going to underperform the QQQ, especially in the short run, as I said, because of the rules. But you will outperform it in a long run, and you protect your equity from having bigger drawdowns. Here, if you're using this approach with the stocks, you will outperform the index, okay? Because you're concentrating. You're concentrating in the less amount of different stocks. You will outperform the index. It will have better risk adjustment returns. So from that perspective, it's better. The con side is you have corporate risk, because now you're operating with every single stock individually, which means that more management, right? So you have more trades to deal with, more orders to go in, get out. It will have different timing when they do. With QQQ, it was, as you saw, like 2 trades per year, 3 trades per year, 1 trade per year, or sometimes 0 trades per year. Here, you will have a lot more churn, right? On top of it, because of the corporate risk, if something happens with the company, some earnings were not right or something else, it can drop a lot more. So you may potentially have higher drawdowns, okay? But on average, as you saw, it's slightly elevated drawdowns, but it has bigger returns. So the risk-adjusted return is better. But just keep that in mind. And from the conclusion perspective, is it doable? Absolutely, it's doable. As I said, even with this simplest system, the channel trading, yes, it's doable. Take your pick, stick with it. If you want to do QQQ, go ahead, do it at QQQ. If you want to do it with the stocks that I'm showing you, do it with the stocks. You can do it quite easily. I had even workshop in similar fashion, but it is pretty easy to do. Now, if you do have questions, don't forget to write it to info@tradingsystems.com. You might as well want to check it out, our tradingsystem.com as well. There is a lot more information over there. You can not subscribe, you can actually sign up for the free, several of free courses over there. So go ahead, sign up, check out the videos, check more obviously on our YouTube channel, and check out these books. And if you do have more questions, book the call. Don't be shy. I'm as open as I am for this video. So don't forget, there's no obligation to join our mentoring. It's under the elite mentoring portion, but you don't have to join our mentoring. So if you have more questions and you want to talk to me in real time instead of the email, we can schedule a call. Or if you want to see more, again, we can schedule a call. I can run you through the whole demo. So anyway, I hope you like it. Leave a like, subscribe to our channel, and check out more. Otherwise, I'll see you next in a different video. Bye.